Will UK house prices crash in 2025, or are we heading for a soft landing? With mortgage rates still elevated, inflation concerns, and a new government promising to build 300,000 homes a year, the housing market is at a critical inflection point. In this video, I'll break down exactly what's happening in the UK housing market right now and what you can expect for the rest of 2025 and beyond. This video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds, and interest on uninvested cash. Let's start with where we are right now. Now, the UK housing market in mid-2025 is showing signs of clear deceleration. In other words, the rate of growth has slowed down. However, this isn't the market crash that many people predicted, largely here on YouTube. But if we look at this data from nationwide, what you can see is that there is a slowdown of annual growth. Now house prices are increasing at just 2.1% in June of 2025. And if we look at other surveys, we see similar patterns of deceleration. So Halifax recorded 2.5% growth and Zoopla just 1.4%. But that's a sharp contrast to where we were in 2024 when house prices were growing at between 4 and 6% a year. Now, as we'll see later on, there's an interesting divergence in the growth rate between regions. So for example, Northern Ireland is still seeing gains of around 10% a year, whereas London is still the laggard and is growing at around 0 to 1% every year. And that regional divergence tells us a lot about the important drivers right now, as we'll see later. So there we focused on growth over the last 6 years. If we zoom out and take a much longer term look at UK house price growth, and we can do that because of this longer term nationwide house price data, the average growth rate has been around 5.7% over the period since 1983. So that makes the current growth rate of 2.4% look much more subdued. Now, whenever you look at the price growth of anything, it makes sense to compare it with inflation. Inflation in the UK has averaged over 3% over this period since 1980. So if we inflation adjust UK house prices, this is how they look, a very different picture. The average real growth rate in UK house prices is a very modest 1.8%. And that's about half of what you'd got if you'd invested in global equity. In fact, the UK housing market in real terms hasn't grown for the last 23 years. Now, before we go on to talk about the reasons behind that deceleration in house price growth, but also where we might be headed in the UK housing market, today's video is sponsored by Lightyear. If you're after a platform with some of the most transparent pricing in the space and a user experience that really stands out, Lightyear is definitely worth a look. Their flexible stocks and shares ISA lets you invest in commission-free ETFs. Just note that fund manager fees and a 0.35% foreign exchange fee may apply, and trade international stocks with a maximum fee of just £1. You can transfer your ISA in or out at any time, and Lightyear is constantly adding more investment options tailored to UK investors. One of the standout features is Lightyear's design and usability, consistently praised by customers and recognized by FinTech Design Awards across both mobile and web. And if you're a business owner looking to invest or an interest on your company cash, Lightyear's business accounts come with the same low-cost transparent pricing. You can try Lightyear using the code PensionCraft, or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. And remember, investing involves risk, and the value of your investments can go down as well as up. Now let's turn to the problems facing the UK housing market. And I'd say the fundamental issue with housing in the UK is its affordability. Average UK property prices have increased almost 2 percentage points faster than wages, and that's over the period since 2000. Now, if we look at the cumulative effect of that, it means that house prices have almost quadrupled over that period, whereas salaries have just more than doubled. Now, for many people, that makes UK houses simply unaffordable. Another problem is to do with supply. The government said it's going to build 300,000 houses a year, But Tim Balkan, who's chief executive of the Construction Industry Training Board, he estimates that you'd need 250,000 new workers just to deliver existing projects. You'd need another 159,000 to meet this government target of 300,000 homes a year. He said, if we train as we currently do, we won't get anywhere near that number. Now, in this graph from the FT, you can see the dependence on immigration for various industries. And what it shows is the number of foreign workers on payroll broken down by industry. And you can see that construction is very heavily dependent on immigration. So this will make this target even more difficult to meet, given the government's pledge to reduce net migration. And the third challenge which the UK housing market still faces is to do with interest rates. Rates have fallen from their peaks, but mortgage rates are still expected to range between 4% and 5% over the course of 2025. And this is a far cry from the rates we've got used to, which were close to zero. The fact is, we're simply not going back to zero interest rates, and will probably settle at around 3%. Nobody really knows where the endpoint will be. Now, not everyone cares about interest rates because a lot of households in the UK own their homes outright. In fact, more households in the UK, around 8.1 million of them, own them outright, compared to just 7.4 million which own with a mortgage. And in fact, that turnaround came before the year 2021. But still, for many new home buyers, a mortgage is how they buy a house, and interest rates matter. Now, there are some specific reasons why house prices have slowed down recently. I think one of those reasons is to do with increased supply. So, for example, if you look at Zoopla's recent report, they say there's been a 14% annual increase in the number of homes for sale. So that means that buyers have more choice, and that's going to limit price growth. And that's particularly true in some regions, such as the southeast and the southwest. Secondly, buyers are very sensitive to price right now. Now, of course, that's always true to some extent, but certainly at the moment with the increase in supply, buyers are very rate sensitive, and that's limiting house price inflation, according to Zoopla. And that's reflected in the time it takes to sell a house. 22% of homes listed have been on the market for over 6 months. And that suggests that pricing expectations from sellers have been unrealistic. To quote Zoopla, they say serious sellers need to be very realistic on pricing as buyers have lots of homes to choose from. And then finally, as you can see in this recent downtick from data from the ONS, changes to stamp duty land tax in April of 2025 meant that there was a surge in sales in March to get ahead of that change, and then we've had a fall in transactions, a very sharp one, in April of 2025. Now, what's also interesting to point out on this graph while I'm here is the upper dark blue line, and that shows the annual increase in rents in the UK. Those are still increasing by 7% a year. So the average monthly rent now is £1,339 a month. So if there is a softening in the housing market, it can only be good news for these poor renters who are seeing their annual rent increase at a fairly rapid rate. So that's where we are right now. Now let's start to turn to where prices could go in future, and economic conditions are very important to that. Now here there are certain economic factors that you should watch which will give you a read on where house prices will go in future. So let's start with things which push up house prices. Wage growth is definitely one of those factors because you can usually borrow a multiple of your income. Now, wage growth has been good, perhaps too good. It certainly spooked the Monetary Policy Committee because high wage growth usually means high inflation, and the Bank of England is trying to reduce that wage growth. But currently the rate of wage growth is around 5.6% a year. That's nominal, and if you adjust for inflation, 1.8% above inflation. But certainly if you're a worker in the UK, that's good news. And it also suggests that house prices will have support from wages. Interest rates are gradually decreasing, so if we listen to what Andrew Bailey, the Bank of England governor, said, he says he really does believe that the path is downward, but the Bank of England always uses the words gradual and careful. Inflation is still above the bank's target, so they're concerned that wage growth has remained sticky, and it's going to be a slow process, I think, of normalisation. But still, the longer term view is that rates will carry on decreasing. Now, a leading indicator of demand for UK housing is mortgage approvals. If those are going up, that suggests strong demand for houses and also house price increases. And certainly in May of 2025, we saw a big bounce back in approvals. Now let's look at the factors driving house prices down. And if you're someone wanting to get on the housing ladder, you'll be cheering on these factors, I suspect. If GDP growth in the UK slows down, then that tends to reduce employment and wages, and that would also push down house prices. Now that's not a pleasant process. It does increase job insecurity, which no one really likes. But I think it would take some kind of shock in order for house prices to snap back more in line with wages. And this is the kind of shock that would cause that. We are seeing unemployment gradually rising in the UK, and that would also have this chilling effect on wage growth and house prices. And of course, we're looking at the effect of tariffs, which we haven't seen fully feed through to the UK economy yet. So now let's look at some actual forecasts for UK house prices. Now for our premium website members, we've got these trackers, and one of those is a forecaster for UK house prices. And it does so very simply. It extrapolates UK wages, so you can see the income forecast in the top panel here, and it has a central case and a bull and bearish case. So the central case is for 5.4% wage growth in the UK, and then we've got the valuation metric in the bottom panel, and there it expects normalization of the price to earnings multiple. Combine those by multiplying them, and the central case is for house price growth of around 4.3% for the UK overall. And if we look at the base case for a wide range of forecasters, here you can see that in a table kindly provided by Mortgage Solutions, what they're expecting is certainly not a house price crash. But it's not great growth either. The estimates range from around 1.1%, that's from the Office for Budget Responsibility, to at most 4.1% for 2025. So a base case of not great growth, but reasonable growth, and certainly no crash. Now previously I mentioned regional variations, and if we look at the valuation measure of price to earnings, so for each region we take the average house price and we divide it by the average annual wage. Notice the huge variations across the UK. Regions which are most expensive, which include London, the outer metropolitan area, the southeast, all of those spiked up to huge price to earnings multiples. But those are precisely where we've seen the biggest falls. And of course, this is a mean reverting measure. We can't have price to earnings multiples increase forever. And that reversion is exactly what we've seen over the last year. If we plot expensiveness on the x-axis versus house price growth on the y-axis, and that's to Q2 of 2025, you can see the inverse relationship very clearly. The regions which are most expensive are the ones which have seen the house prices actually fall, whereas regions that were previously cheap have seen the greatest house price appreciation. So that would include the North, Scotland, and in particular Northern Ireland, which came off a very low base. Now around that base case, we have to consider some risk scenarios which could push things deeply in one direction or the other. I've ranked these according to likelihood. I think the most likely one is that we're going to get planning log jams. So in other words, the number of new completions, houses which have been built and which can be sold, will be lower than expected. So if that does happen, I'd expect there to be a price rise of around 5%, and that's despite weak UK growth. It just seems as if the government's policies for house building aren't in line with their policies on immigration. Then moving to a slightly less likely scenario where we get an energy price shock, where oil prices, gas prices spike upwards, push up inflation and then push up interest rates. That of course has a chilling effect on the UK housing market. In that scenario, I'd expect prices in the UK to stall. And the least likely risk case is one in which the Bank of England cuts much more rapidly than people expect. That of course would create a spike in house prices. Now that spike would be short-lived because once the initial excitement about the rapidly dropping rate starts to subside, activity would slow down again. So in conclusion then, I think the evidence really does point towards a soft landing. Not a great increase in house prices unless we get one of those risk scenarios, but certainly no crash either. What is good news, I think, for people looking to get on the housing ladder is that the government is at least trying very hard to increase supply. Also, we're seeing affordability measures become more reasonable, as house price growth has actually been lower than wage growth. So I'd say the most likely scenario is low to single digit appreciation. That would be faster in the north and also the devolved nations, and subdued where price to income ratios are higher, particularly in the south. So not the price crash that many people have predicted, but just a gradual normalization that should benefit both buyers and the broader economy. Now don't forget our special offer from Lightyear. If you use the code PensionCraft or follow the link in the description below, you can get up to $115 worth of a US fractional share in your general investment account. And also remember that investing involves risk and the value of your investments can go down as well as up. And, as always, thank you for listening.